All right, in this presentation we're going to look at how we'd convert convertible bonds into common stock. That would be a debt for equity swap here. And we're going to be using the residual or incremental method. And we're not going to be doing any induced conversions. The first example here would be just where we would take and swap bonds for common stock. And then the second example is where we'd actually retire these bonds by paying our bondholders a cash amount for the bonds. But before we get into that, we're going to go through and we're going to show how to allocate these bonds between the liability and equity accounts here, since they represent both, and we have to do that in order to do our calculations here when we use the residual and incremental method. All right, let's go through our example here, and we're going to start out here when the bonds are issued. So we get a 5-year, $100,000, 7% convertible bond, and you can convert each bond into 25 shares of common stock. And the current market value of those stocks are $3.50 per share. So the first thing we have to do here is we have to determine the liability portion of that bond. And we do that by taking a similar bond without the conversion feature, and we would discount it back to its present value today. So for the example here, I took that similar bond and I discounted it back here to $96,150. That's its present value. So we'd increase our bonds payable amount by that amount here. Now, we have to calculate the equity portion that we have to assign to that bond. And we do that by taking the bond's par value amount here, and in this case it would be $100,000, or we debit cash for that amount here as our asset. And then to determine the equity portion here, and in this case it would be in a surplus account, and it would be the conversion rights of those bonds. And we would do that by taking the par value of the bond less its liability portion here, and the difference here would be, in this case, would be $3,850. We'd credit our additional paid-in capital for $3,850. So here we assigned the debt portion of our bond liability here, and also our equity portion of our bond liability. Okay, let's look at a conversion before maturity of these convertible bonds. So what we're doing here is we're swapping this debt here for equity. We're going to exchange these bonds here for stock. And what we have to use is a method consistent when the bonds were first recorded. And that was our residual or incremental method. So first thing we have to do here is we have to go down and we have to determine the carrying value of that convertible bond at the time of the conversion. So in this case, I'm showing here a $98,652 carrying value of that convertible bond. So we go up here to our bonds payable account, and we debit it, or we'd or decrease it here by that carrying value amount of those convertible bonds. Then the next thing that we'd have to do here is we'd have to take the surplus account here for these conversion rights. I had it put in as additional paid-in capital, and we'd have to close that out because they no longer exist here. And then the balancing amount here would go into the common stock account here, where we traded here these bonds payable for common stock. And that common stock account here would be based on the bond's carrying value plus those conversion rights. And that, you can see, was $102,502 here. All right, let's look how we'd retire this debt before maturity, where we would not exchange common stock for the bonds. All we'd pay is our bondholders a cash amount to retire these bonds. So the first thing we have to do is go down here and determine the carrying value of those bonds at the retirement date. So we debit our bonds payable or reduce it by that carrying value amount of those bonds. Then we'd also close out this surplus account here for those conversion rights. And then going up here to our cash account, we'd decrease that by the amount that we paid to our bondholders to retire those bonds here. And that was for $107,000. Now we'd also go down here and record a debt retirement cost here, an expense, which is part of net income on the income statement here. And that again is based on the bond's fair value. We'd have to determine the fair value of those bonds at the retirement date here. and then we would subtract the bond's carrying value and to determine that expense here for the debt retirement of those bonds. Then we go up here to retained earnings, and that's really a balance account here between our debits and credits here. So we would have a debits here in bonds payable, additional paid in cash here, and this expense here, plus this retained earnings. And that has to balance with the cash that we paid to retire those bonds. Okay, in review, you're going to have to be able to determine the carrying value of these convertible bonds at their conversion or retirement date. And you're also going to have to be able to determine the bond's fair market value at the date of issue, and also when we do the retirement here or the conversion here, so we can determine the debt retirement cost. And also, you just remember we're using the residual incremental method. So when you first issue the bond and then your retirements or conversions thereafter, you got to continue on with the same method. Now, you can go through this video here and look at the journal entries, and just remember they're laid out here where you've got the assets equal liabilities and equal plus the stockholders' equity, plus you have your net income shown over here. So these are laid out in T-account form, and then you've got them shown here as your balance sheet items and then your income statement items.